Assalamualaikum. Now I will present financial performance for subject FIN2603. And now I will be explain about Mr. DIY background. Mr. DIY Group Berhad was established in 2005 in Malaysia. The company began as a small hardware store and successfully expanded into one of the largest home improvement retailer in Southeast Asia. Mr. DIY is well known for offering affordable product through its always low price concept. The company sells various products such as household goods, toy, stationery, and lifestyle items to meet customer needs. In addition, the company introduced other retail brands such as Miss Dollar and Mr. Toy to attract more customers. In 2020, Mr. DIY was listed on Bursa Malaysia, which helped support its business growth and expansion. Today, the company continues to improve its operation and expand internationally. Now, I will explain about 99 Speedmart background. So, for 99 Speedmart background, 99 Speedmart Retail Holding Berhad was established in 1987 and started as a small traditional grocery shop. Over the years, the company has grown into one of the largest mini market chains in Malaysia. The company mainly sells daily essential products such as food, beverage, and household goods. Most of its stores are located in residential area, making it easier and more convenient for customers to shop. One of the company's main strengths is its efficient supply chain and centralized distribution system, which help reduce costs and improve product availability. In recent years, 99 Speedmart has continued to expand its store across Malaysia while improving its operation through technology and automation. Now, I will be explain about current ratio. So, the current ratio is used to measure a company's ability to pay its short-term liability using its current asset. The formula for current ratio is current asset divided by current liability. So, for Mr. DIY recorded a current ratio of 2.38 times. This means that the company has 2 ringgit 35 cents of current asset for every 1 ringgit of current liabilities. This ratio is considered good because it shows that the company has sufficient liquidity to pay its short-term debts. So for 99 Speedmart recorded a current ratio of 1.74 times. This means that the company has 1 ringgit 74 cents of current asset for every 1 ringgit of current liabilities. Although the company is still able to pay its short-term liabilities, the ratio is lower compared to Mr. DIY, so its liquidity position is considered weaker. In conclusion, Mr. DIY has a higher current ratio compared to 99 Speedmart. This indicates that Mr. DIY is in a stronger short-term financial position. It's more capable of meeting its current obligation. I will explain about quick ratio. The quick ratio is used to measure a company's ability to pay its short-term liability using its most liquid asset. Inventory and prepaid expenses are excluded because they cannot be easily converted into cash in a short period of time. The formula for quick ratio is current asset minus inventory minus prepaid expenses divided by current liabilities. So for Mr. DIY recorded a quick ratio of 1.68 times. This means that the company has 60 cents of liquid asset for every 1 ringgit of current liabilities. Although the ratio is below 1, it is still considered better compared to 99 Speedmart because the company has a stronger liquidity position. 99 Speedmart recorded a quick ratio of 1.63 times. This means that the company has 63 cents of liquid assets to pay for every 1 ringgit of current liabilities. The ratio is slightly lower than Mr. DIY, which shows that the company has a weaker ability to meet its short-term obligation using liquid assets. In conclusion, Mr. DIY has a higher quick ratio compared to 99 Speedmart. This indicates that Mr. DIY is in a better short-term liquidity position and is more capable of paying its current liability using liquid assets.
Next, I will explain the inventory turnover ratio. The formula for inventory turnover is sales divided by inventory. For Mr. DIY, the calculation is 2518700 divided by 1082449, which equals 2.50 times per year. This means Mr. DIY sells and replaces its inventory about 2 times per year. For Speedmart, the calculation is 8877310 divided by 1339042, which equals 6.63 times per year. This shows Speedmart sells inventory faster and manages stock more efficiently compared to Mr. DIY. Next, I will explain the average collective period. The formula is receivable divided by sales over 365. For Mr. DIY, the calculation is 148471 divided by 4651 divided by 365, which equals 11.65 days or approximately 12 days. This means Mr. DIY takes around 12 days to collect payment from customer. For Speedmart, the calculation is 15344 divided by 99816 divided by 365, which equals 0.56 days approximately or 1 day. This shows Speedmart collects payment very quickly and has better cash flow management. Next, I will explain the total asset turnover ratio. The formula is sales divided by total asset. For Mr. DIY, the calculation is 4659416 divided by 3809950, which equals 1.22 times per year. This means every 1 ringgit of asset generates 1.22 inches, RM 1.22 inches. For Speedmart, the calculation is 9981642 divided by 3561150, which equals 2.80 times per year. This shows Speedmart uses its asset more effectively to generate sales compared to Mr. DIY.
Hi,
Hi, my name is Nuhara. I'm designer and I'll be explaining about debt ratio. So the debt ratio shows how much of a company's business is funded by borrowed money. Mr. DIY is in a good position because its ratio is 49.04%, meaning less than half of what it owns is debt. It effectively owns more than it owes, which is financially safe. On the other hand, Speedmart has a poor rating with a higher ratio of 55 and 66%, meaning more than half of its assets are funded by debt. This makes Speedmart riskier because it relies more heavily on loans to run its business, leaving it with less of a safety net. Sales were to drop. Overall, Mr. DIY is more financially stable because it has a better balance between its own money and borrowed funds. Now let's go to time interest ratio. This ratio measures how easily a company can pay the interest on its loans. Speedmart is the winner here because its profit is 15 times larger than its interest bills, giving it a massive safety net to cover its debt costs. Mr. DIY has a smaller cushion with profit only 10 times larger than its interest. While Mr. DIY can still pay its bills, it would be more vulnerable if its profit were to suddenly drop. Let's go to net profit margin ratio. Net profit margins tell us how much actual profit is left over from every dollar of sales. Mr. DIY is very efficient at making money, keeping about 12 cents as pure profit for every dollar sold. Speedmart operates on much thinner margins, keeping less than 5 cents for every dollar. This means Speedmart has very little room for error, as even a small increase in cost could quickly eat up all its profit.
For my part, I will continue to present the financial ratio analysis for return on assets ROA and return on equity ROE between Mr. DIY and Speedmart for the year 2024. First, let's look at the return on assets or ROA. ROA measures how efficient a company is in using its total assets to generate profit. The formula for ROA is calculated by dividing net income by total assets. For Mr. DIY, the ROA is calculated using a net income of 568,937 divided by total assets of 3801950, which give a result of 14.96%. Meanwhile, Speedmart recorded a net income of 490265 and total assets of 3561150, resulting in an ROA of 13.77%. Based on this result, Mr. DIY have a slightly higher ROA compared to Speedmart. This shows that Mr. DIY is more efficient in utilizing its assets to generate profit. Therefore, Mr. DIY is interpreted as good, while Speedmart is considered poor in terms of asset efficiency. Next, let's move to return on equity or ROE. ROE measures how effectively a company uses shareholders' equity to generate earnings. The formula for ROE is calculated by dividing net income by shareholders' equity. For Mr. DIY, the ROE is calculated from a net income of 568,937 divided by shareholders' equity of 1,937,535, which give to 9.36%. On the other hand, Speedmart recorded a net income of 490,265 and shareholders' equity of 157,8976, resulting in a higher ROA of 31.05%. This means that Speedmart is more effective in generating returns for its shareholders compared to Mr. DIY. Therefore, Speedmart is interpreted as good, while Mr. DIY is considered poor for ROE performance. In conclusion, Mr. DIY performs better in managing its assets, while Speedmart performs better in generating returns for shareholders' equity. Both companies show different strength in financial performance.
Now, let's go to question number 3, which is evaluate the company performance, which is its cash flow. Based on the data provided, Mr. DIY is currently the more financially stable of the two, boasting high liquidity ratios and growing free cash flow that allow it to meet its bills comfortably. In contrast, 99 Speedmart is prioritizing aggressive growth and expansion following its IPO. While it is profitable and can still pay its debts, its cash reserves have dropped sharply due to heavy reinvestment. Essentially, Mr. DIY represents steady reliability, while 99 Speedmart represents a high growth phase that requires more careful monitoring of its cash stability. Now let's go to asset management efficiency. In short, these two companies operate on completely different business models based on their industries. 99 Speedmart is a high velocity business. As a grocery chain, it moves inventory more than twice as fast as Mr. DIY every 55 days and generates much higher sales per dollar of assets. Mr. DIY, on the other hand, follows a slower but steadier pace typical of hardware stores because its goods don't expire. It can afford to hold stock longer, 157 days, while focusing on higher profit margins per item rather than pure volume. Basically, 99 Speedmart wins on speed and volume, while Mr. DIY wins on stability and margin. Let's look at debt management. Mr. DIY follows a more conservative approach with a 49.04% debt ratio, meaning it owns more of its asset than it owes to lenders, providing a solid safety net. 99 Speedmart takes a more aggressive path with
a 55.66% debt ratio. Using more leveraged borrowed money to fuel its rapid expansion while both are in a healthy range, 99 Speedmart's strategy offers higher potential growth but carries more risk as it relies on constant daily sales to keep up with a higher repayment obligation. Let's look at profitability trends over 2 consecutive years. In summary, Mr. DIY is a high margin leader, keeping over 12 cents of profit for every dollar sold, which is very impressive for retail. 99 Speedmarts operate on much thinner margin at 4.91%, which is standard for the competitive grocery industry where low prices are used to drive high volume. However, despite making less profit per item, 99 Speedmart is so efficient at moving products and using its asset that its return on asset ROA of 13.77% is nearly as strong as Mr. DIY 14.96%. Essentially, Mr. DIY wins on the value of each sales, while 99 Speedmart stays competitive through sheer efficiency and speed. Thank you.
Next, I will walk you through 4 actionable initiatives to improve financial performance for 99 Speedmart and Mr. DIY based on their profitability trends over 2 consecutive years. So, the first one is optimize inventory management using data analytics. First, 99 Speedmart holds 1.34 billion in inventory with turnover of 7 times per year. Still, they can improve further by using real-time sales data and automated replenishment to reduce risk and free up working capital. Mr. DIY, however, has a much slower turnover, just 2.33 times per year. Product sits too long on shelf. Our recommendation: categorize inventory by sales key, reduce order for slow movers, and use predictive analytics. Both companies will see lower holding costs, better cash flow, and improve asset efficiency. The next one is shift from to owner strategy store asset. 99 Speedmart is liability crew to 884 million, yet they hold 698 million in cash. They should purchase high performing store properties to lock in costs and eliminate rental inflation. Mr. DIY has even larger lease liabilities at 1.42 billion with smaller cash reserves. They should start with the top 50 to 100 stores, converting to on asset trains, balance sheets, and improve debt to equity ratios. The third one is private label project. 99 Speedmart gross margin is thin at just 11.86% by introducing private label items like bottled water, bakeries, and snacks. They can achieve 20 until 30% margins, potentially adding 100 to 200 million in gross profit annually. Mr. DIY already has a healthy 45.8% margin, but they can go further, especially in basic tools where brand loyalty is low. The last one is put excess cash to work. 99 Speedmart holds 268 million in cash after reserving 200 million for operations. The remaining 568 million can be invested in fixed deposit, government securities, and money market funds, yielding around 3.8% that generates slowly to 90 million in annual basic income. Mr. DIY has 10 million in cash after operational reserves. They could invest operationally RM180 million to earn 6.5 million per year. Alternatively, Mr. DIY could reduce its fixed deposit, government securities, and money market funds, yielding around 3.8% that generates slowly to 90 million in annual basic income. Mr. DIY has 10 million in cash after operational reserves. They could invest operationally RM180 million to earn 6.5 million per year. Alternatively, Mr. DIY could reduce its 1 to 8 million in short-term borrowings, effectively earning a risk-free return equal to the interest rate saved. But companies could enhance return without taking on equity risk.
For this part, I will continue the presentation on the competitive analysis between Mr. DIY and 99 Speedmart based on leverage ratios and efficiency ratios. First, for the leverage or debt ratios measure how much a company depends on debt to finance its assets and operations. Starting with Mr. DIY Group Berhad, the company records a debt ratio of 4904%, which means less than half of its assets are financed through debt. This shows that Mr. DIY has a moderate and balanced debt position. The company also has a strong current ratio of 2.38 and a quick ratio of 0.68, indicating that it is financially stable and able to meet its short-term obligation comfortably. In addition, the company free cash flow increased during the financial year 2023 to 2024, which reflects efficient cash flow management and strong operational performance. Next, for 99 Speedmart Retail Holdings Berhad, the company has a higher debt ratio of 55.66%, meaning more than half of its assets are financed through debt. This is mainly due due to the company aggressive expansion strategy and investment in new outlets after its IPO. The current ratio of 1.74 and quick ratio of 0.63 shows that the company is still capable of meeting short-term liabilities, but its liquidity position is weaker compared to Mr. DIY. Furthermore, the company experienced a significant decline in cash flow in 2034 because of high investment spending, which may increase financial pressure in the future. Overall, Mr. DIY shows a stronger leverage position because it has lower debt dependency, stronger liquidity, and more stable cash flow management. Meanwhile, the 99 Speed might use higher leverage to support rapid business growth, but this also increase financial risk. Now, moving on to efficiency ratios. Efficiency ratios evaluate how effectively a company manage its assets, inventory, and operation to generate sales and profits. For Mr. DIY Group Berhad, the company demonstrate efficient operational management through stable cash generation and effective use of resources. Its growing free cash flow shows that the company manage operating expenses, inventory, and investment efficiently. The strong liquidity position also reflects good working capital management, allowing the company to maintain profitability and smooth operation. On the other hand, 99 Speed Mart shows strong operational efficiency in terms of sales growth and customer demand. As a grocery retail chain, the company benefits from less inventory turnover and continuous daily cash inflows. However, the sharp decline in cash flow during the financial year 2024 suggests that expansion and investment activities have reduced short-term operational efficiency and increased financial pressure. In conclusion, both companies perform well in the retail industry. However, Mr. DIY appears to be more financially stable with better cash flow management, while 99 Speed Mart focuses more on aggressive expansion and rapid business growth. Finally, this part we have for question 2, which is B, about strengths and opportunities. For Mr. DIY, first strength is wide product range. Mr. DIY offers a very wide variety of products such as household items, hardware, stationery, toys, electric accessory, and personal care products. This allows customers to buy many different products in one place, making shopping more convenient and saving time. The affordable pricing strategy also attracts customers from different income groups. Second point, we have strong brand recognition, which is Mr. DIY has built a strong brand image in Malaysia through its large number of outlets and consistent advertising. Many consumers recognize the brand as a reliable and affordable retail stores. Its strong reputation helps the company maintain customer loyalty and attract new customers. About opportunities, we have expansion to ASEAN market, which is Mr. DIY has the opportunity to expand its business into more ASEAN countries such as Indonesia, Vietnam, and the Philippines. The growing population and increasing demand for affordable households product in these countries can help the company increase its sales and market share internationally. Second point is growth e-commerce, which is the rapid growth of online shopping provides Mr. DIY with the opportunity to strengthen its e-commerce platform by improving online service, delivery system, and digital marketing strategy. The company can attract more customers who prefer shopping online. This slide shows the strengths and opportunities for the 99 Speed Mart. About strengths, first point is strong retail network, which is 99 Speed Mart has a strong retail network with thousands of outlets located in residential and strategic areas across Malaysia. This makes it easy for customers to access the stores and purchase daily necessities conveniently. Second point is we have a high customer frequency, which is the company experience high customer frequency because consumers regularly visit the stores to buy essential goods such as food, beverages, and household items. Competitive price and convenient location encourage repeat purchases and customer loyalty. Next, we move on to the opportunities. First point is increased number of outlets, which is 99 Speed Mart has the opportunity to expand by opening more outlets in rural and urban areas. This expansion can help the company reach more customers, strengthen its market presence, and increase overall revenue. Second point, we have improved logistics and distribution, which is the company can improve its logistics and distribution system to ensure faster delivery and better stock management. Efficient supply chain operation can reduce costs, improve product availability, and increase customer satisfaction.